In this video, I will cover what a health savings account is and how it is the hidden gem in building wealth. A health savings account is a triple tax advantage account and is one of the most advantageous ways to legally stick it to our favorite uncle. In this video, I'm going to cover what a health savings account is and how they work, what a qualified medical expense is, how to qualify for a health savings account and how to open one, should you open a health savings account, finally, an advanced planning strategy you can easily implement to maximize your money. A health savings account, aka an HSA, is a tax advantage account separate from your other investment accounts like your 401k or IRA. Still, it acts similar to one with some extra benefits, namely that you can use the money for qualified medical expenses tax-free. The primary purpose of a health savings account is to use tax-free money to pay for qualified medical expenses. The money you contribute to your health savings account, you don't pay income taxes on. If you have a qualified medical expense, you can use your health savings account to pay for it tax-free through either an HSA-issued debit card or electronic check. You can also get reimbursed from your health savings account for a qualified medical expense you pay for in cash or credit card. Just be sure to save your receipts. This is personally what Sarah and I do. We use our credit card to pay for qualified medical expenses and at the end of the month get reimbursed from our HSA. A bonus doing it this way is we get 2% cash back from our credit card. Be careful using credit cards though, and do not do this if you have trouble paying them off every month. You can only reimburse yourself for qualified medical expenses that you incurred after your HSA was established. If you established your HSA in September of 2020, you can only be reimbursed for expenses incurred in September 2020 and later. One of the best benefits of a health savings account is the ability to invest your money into index funds and allow it to grow tax-free to pay for qualified medical expenses. Our HSA is through Fidelity. We have it set to keep $7,500 in our cash balance. Everything above the $7,500 will automatically be invested in Fidelity's Total Stock Market Index Fund, ticker symbol FSKAX. Our current maximum out-of-pocket for our family is $7,500, so we have it set up like this. This is why they are considered triple tax advantaged. 1. Tax deduction when you contribute to your HSA. 2. You can invest your money within your HSA to grow tax-free. 3. If you use the money in your HSA to pay for qualified medical expenses, you do not pay income tax on the growth. Another bonus of a health savings account is you can take distributions from it penalty-free at age 65 or older and use the money for whatever you want. You'll pay ordinary income taxes on the distributions just like your traditional 401k or IRA, making health savings accounts an additional tax advantage retirement account. You pay income tax on this type of distribution because you get a tax deduction up front. Remember, no income taxes are paid if the money is used for qualified medical expenses. Do not use the money for expenses other than qualified medical expenses before the age of 65, or you will be assessed a 20% penalty on top of it being taxed. Unlike traditional IRAs and 401ks that have required minimum distributions starting at age 72, health savings accounts do not have required minimum distributions. As of 2020, if you are single, you can contribute up to $1,550 per year to a health savings account and $7,100 for families. Families are defined as you and your spouse or claimed dependents, like your children. If you are age 55 or older, by the end of the calendar year, you can contribute an additional $1,000, and if your spouse is also 55 or older, you can double that amount to $2,000. Unlike FSAs or flexible spending accounts, a health savings account is not a use it or lose it account. Money put into your health savings account stays there and continues to grow if the money is invested until you take a distribution. Bonus tip: if you contribute through your employer via a payroll deduction, your contribution is not subject to Social Security or Medicare taxes. Also, you have until the tax deadline the following year to make contributions. This date is typically April 15th for your federal return. For example, in 2021, if you haven't maxed out your HSA for 2020, you can max it out by April 15th in 2021. This allows you to take a tax deduction on your 2020 return and enables you to contribute your maximum limit for 2021 still. These contribution limits are adjusted for inflation every year by $50 or so. Everything I have talked about applies to your federal tax return. While HSAs are tax exempt in most states, some states differ from your federal tax return. Do a quick internet search to see if they are deductible in your state or allow following year contributions for a previous tax year. Also, a quick internet search will tell you current year contribution limits. Qualified medical expenses are any medical, dental, vision, and prescription expenses. This includes counseling for mental health in most situations. There's a link in the description of a robust list of what qualifies. You'd be surprised what qualifies. Everything from bandages to birth control. The CARES Act expanded what is considered a qualified medical expense to include over-the-counter medication and feminine care products. The coverage is retroactive to January 1, 2020 and doesn't expire until Congress changes it. Medicine like Tylenol and Benadryl now counts as a qualified medical expense along with feminine care products. As of 2020, to qualify for a health savings account, you need to be enrolled in a high-deductible health plan. A high deductible is an annual minimum deductible of $1,350 for individuals and $2,700 for families. The yearly out-of-pocket maximum cannot be over $6,750 for individuals and $13,500 for families. A quick internet search will give you up-to-date amounts. The plans must be structured to where you pay the first medical costs up to your deductible before insurance kicks in. An exception to this is preventative care. Preventative care includes things like immunizations, routine well child care, routine prenatal, and annual physicals, to name a few. If you are enrolled in Medicare or are claimed as a dependent, you are disqualified from opening an HSA. Check first with your employer to see if they offer high-deductible health plans and a health savings account. Some employers will contribute on your behalf to an HSA. Keep in mind, if they do, this counts towards your overall contribution limit but isn't subject to income tax. If your employer doesn't offer a health savings account, but your health insurance is a high-deductible plan, you can open your own HSA through a brokerage like Fidelity or Charles Schwab. If your current health plan is a PPO or what is considered by some to be low deductible, but it at least adheres to the high deductible health plan, it is considered by the IRS to be a high deductible health plan, qualifying you to be able to open a health savings account. Again, if your health plan adheres to the IRS rules of a high deductible health plan, you can open an HSA. One catch is you can't also participate in an FSA, a flexible spending account, and a health savings account at the same time. A couple of exceptions are limited FSA or combination FSA, which covers dental, vision, and preventative care expenses. These are allowed to be paired with a health savings account. If your spouse is not on your health plan, you can use your HSA funds to pay for their qualified medical expenses, even if they are not covered under a high deductible plan. This goes for dependents as well. Just make sure the expenses are not reimbursed from some other source. Your spouse will inherit your HSA with the same benefits when you pass away. Heirs other than spouses, the HSA becomes ordinary income and is taxed at ordinary rates. Unlike IRAs or individual retirement accounts that have income limits to qualify, a health savings account does not have an income limit. There is no income limit to qualify for a health savings account. If you make $1 million a year and have a high deductible health plan, you can open a health savings account. If you have health issues and have tons of medical bills, a low deductible health plan might be the way to go and forego having a health savings account. Just be sure to run the numbers on if the premium is worth it. You might be better served by switching to a high deductible plan and contributing the difference in premiums to a health savings account. If you only use health insurance for emergencies, then most likely a high deductible plan is for you because of the benefits of a health savings account and lower premiums. Do your research before deciding. One of the best things about a health savings account is being able to invest your contributions. As mentioned previously, you can pay for medical bills out of your pocket and then later reimburse yourself with your HSA. Remember, you can only reimburse yourself for qualified medical expenses incurred after your HSA was established. There is no time limit on when you can reimburse yourself. You can wait 10 or 20 years if you want to. Just be sure to save your receipts. This allows a portion of your HSA that's invested to grow tax-free, further maximizing the potential of your health savings account. A simple example of this in action. You contribute $3,500 a year to your HSA and invest this money into a total U.S. stock market index fund. You also incur $3,500 a year in qualified medical expenses. Instead of using your HSA to pay for these expenses, you pay for these in cash from a different source. You do this for 20 years. The U.S. market historically has returned between 8 and 12% a year. Let's use an 8% return for our example. $3,500 invested for 20 years at an 8% return will give you roughly $160,000. At the end of 20 years, you reimburse yourself for your medical bills for a total of $70,000, leaving you with roughly $90,000 in your HSA. Let me say that again. You will have invested $70,000 of your own money, but will have made $90,000 for doing nothing. This is the power of compound interest, the eighth wonder of the world. Here's a quick recap of what was covered in this video. Health savings accounts are a great way to build wealth and pay for qualified medical expenses. Anyone can open an HSA as long as you have a high deductible health plan. There is no income limit to qualify for a health savings account. Health savings accounts do not have required minimum distributions. As of 2020, if you're single, you can contribute up to $3,550 per year to a health savings account and $7,100 for families. An HSA is a triple tax advantage account. You get a tax deduction when you contribute. You can invest the money within your HSA to grow tax-free. If you use the money to pay for qualified medical expenses, you do not pay income tax on the distribution. Bonus tip: you can pay for your spouse and dependents' qualified medical expenses even if they are not covered on your health plan. It doesn't matter if they have a high or low deductible plan, you can still use your HSA to pay for them. A health savings account is one of the most advantageous ways to legally stick it to our favorite uncle. Unlike FSAs or flexible spending accounts, a health savings account is not a use it or lose it account. Money put into your health savings account stays there and continues to grow if the money is invested until you take a distribution. Finally, the icing on the cake of a health savings account is you can take distributions from it penalty-free at the age of 65 or older and use the money for whatever you want. You'll pay ordinary income taxes on the money just like your traditional 401k or IRA, making health savings accounts an additional tax advantage retirement account. You pay income tax on this type of distribution because you get a tax deduction up front. Remember, no income taxes are paid if money is used for qualified medical expenses. That's it for this video. Please hit the like button if you enjoyed it and consider subscribing to the channel for all things money, taxes, and tech. I am also on Instagram and TikTok. See you next time.